Good afternoon and welcome to the Pabrai Wagons Fund shareholder call. We appreciate you joining us. Before I begin, Khan Tran, the fund's distribution manager, has a few disclosures that he needs to share with all of you.
Good afternoon and welcome again to the Pabrai Wagons Fund investor call. Before we begin, let us start with the usual disclosures. Mutual fund investing involves risks, including the potential loss of principal. The fund is non-diversified, meaning it may focus its assets in fewer individual holdings than a diversified fund. Therefore, the fund is more exposed to individual stock volatility than a diversified fund. The fund may invest in small and medium capitalization companies, which involve additional risks such as limited liquidity and greater volatility than larger capitalization companies. The fund is new with limited operating history, and there could be no guarantee that the fund will grow to or maintain an economically viable size. Past performance does not guarantee future results. Opinions expressed are subject to change, are not intended to be forecast for future events, a guarantee of future results, nor investment advice. Fund holdings and allocation are subject to change at any time and should not be considered a recommendation to buy or sell any security. Now, I'd like to hand the call over to our portfolio manager, Monish Pabrai.
Thank you, Khan. Format of the call is that we've received a number of pre-submitted questions. In fact, I was quite impressed with the quality of the questions. This shows a great base of investors in the funds. I'll try to get through as many of them as possible. We also have Q&A tab at the bottom of your screen, and you can send in questions through that chat window, the Q&A one. And I don't know if I'll be able to get to any of those since we have just an hour. But if I see some great questions there, which are better than what we have on our list, then I'll look at that as well. And given the volume of questions we've been getting, we've switched to quarterly call format so that we can try to address as many of these. We may go back to a semi-annual format in the future, and please look out for more information on future calls or our website on that front. So we have questions that we've categorized into different areas. There's a bunch of questions on recent fund performance. We have questions on holdings, some different holdings which we've tried to group together. I'll try to go through basically one or two questions in each category before I come back to the same category again. So the first question is, given the drawdown in NAV, how does the manager manage redemptions? Given two large positions, are there liquid stocks and are there similar percentage of the other partnerships or separate accounts the firm manages? That's a very good question. So as all of you know, mutual funds have daily liquidity, and we usually do not get any advance notice when people are subscribing or redeeming. And that's typically how most mutual funds function. In order to maintain some semblance of stability and manage redemptions, what the Wagons Fund does is at all times we maintain a seven-figure cash balance. So we've got sufficient cash. In addition, we've got obviously subscriptions coming in, and the fund rules generally discourage people from dancing in and out. There's a redemption fee if you're leaving within 90 days. So our experience in the last, let's say 18 or 19 months that we've been running the funds is there have only been 2 or 3 days in that entire period when redemptions have exceeded subscriptions and exceeded cash. We used to not have much cash. The seven-figure cash is a more recent development, but basically we only had 2 or 3 days when that happened out of probably more than 400 days, so less than 1% of days. And we have several levers that we can pull to manage that. The first lever is obviously the cash we have, the subscriptions we have coming in. We also have the ability to ask our custodians and brokers to give us same-day settlement. And so instead of having a next day or 2-day settlement, we can have same-day settlement. The same-day settlement is a very strong lever because a large portion of the fund's holdings are traded in the US and they have sufficient liquidity. The fund has 15 to 20 positions. So even in these 3-4 days, when we had 2 or 3 days when we had more redemptions and subscriptions, we only had to sell a small portion of one security, and that took care of it. And the other good thing that has happened is that through the market volatility and downturn, our investor base has continued to add assets. So even on days when the indices have been down, etc., we've seen net inflows. In fact, we've seen net inflows almost every day for the last several months. And so that's been wonderful because it's allowed us to buy more of what we like at better prices. So let me switch gears, and I'm going to take a question on Edelweiss. So there's a couple of questions. I'll take them both because their first one shouldn't take much time. Because how do you legally acquire pieces of otherwise inaccessible companies like Edelweiss? Well, Edelweiss is traded in India. It's generally speaking not that easy for retail US investors to access it. It took us, even for a Pabrai Wagons fund, took us some time to get access. But now we can buy and sell any stock that's traded in India, including Edelweiss, just like any US stock. So we don't have any issues on that front. And then another question on Edelweiss, and I'm taking the couple of questions because Edelweiss represents more than a fifth of our assets. I have seen how in the past you have said you will not invest in financial institutions / banking companies, with Edelweiss being the largest position in the fund. Is this due to lack of better opportunities and therefore being forced to look back at sectors you previously have stayed away from? Well, that's a good question. And yes, I actually am not very interested in levered financial institutions. We've had a lot of difficulty with those in my career as a professional investor. And there is a part of Edelweiss which has a lending operation. Most of it is in runoff. I mean, they got their head handed to them a few years back with some of that lending, which is what led to pricing that made it attractive for us to step in. But most of Edelweiss's businesses are not lending oriented. They have a wealth management business that they spun out a couple of years ago. And that's been, just to show you how the market caps are doing. Edelweiss has a market cap of about $1 billion. The wealth management business that they spun out about 2 years ago has a market cap of about $2.5 billion. And Edelweiss used to have, a majority of that business not that far back. The reason we have the high conviction in Edelweiss, and of course nothing is guaranteed, but basically they are going to be spinning off about 4 or 5 different companies in the next 4 or 5 years. One of them, which is Edelweiss Alternative Asset Management, is going to have an IPO pretty imminently. I think Edelweiss might be having a quarterly call tomorrow, so we might get some color on that. But my best information is that within a quarter, they will IPO that business. I think that business will IPO, and Edelweiss owns 100% of that business. When they IPO that business, I think that business will have a market cap of about $1 billion or more, and the entire market cap of Edelweiss is $1 billion. Then they have their mutual fund business, which is scaling very nicely. They have a few insurance businesses. They have a asset restructuring business. So these may become candidates to go public in the next few years. And so our interest is really in these individual businesses as they go public, and basically we will get allocated shares. And so that's why we have an interest in Edelweiss. I'm going to switch gears. There's some questions on Turkey. With the Turkish positions and Turkish market overall coming down in price, have you viewed this as an opportunity to increase positions? Or with the turmoil currently in the economy, have you lessened your conviction in these companies? Yeah, our bet is not so much on Turkey. I'm a bottoms-up investor, so we have an interest in specific businesses that happen to be trading in Turkey or headquartered there. For example, one of our businesses in Turkey, TAV Airports, a large portion of their operations are outside Turkey. A lot of their cash flows are outside Turkey. And even within Turkey, the airports that they manage, they are contractually getting paid in euros, all the passenger fees and all that. So they're not really that connected to the Turkish economy, etc. And another position that we have, which is Resas, which is also, again, it's our interest in an undervalued security that has very strong recurring revenue and such. So that's what's driving our interest. I'll come back to Turkey if we have time, but I'll keep going. There's several questions on coal. Let me just see. One of the coal questions is AMR, that's Alpha Metallurgical Resources, repurchased approximately 250 million of stock between Q4 23 and Q1 24, likely at a minimum price of 215 and possibly as high as 400 per share. The current price of Alpha is around 120 odd dollars. With repurchases at 2 to 3x current share prices, I am wondering if you have had discussions with management. I am also wondering how these companies can rectify the poor capital allocation given that repurchases have slowed to a trickle, and when they could be buying back 2x the number of shares at current price levels compared to what they did previously. So regarding Alpha, we have a lot of respect for Alpha's management and board. I don't have any disagreement at all with the way Alpha has managed their repurchases and how they have at the prices they bought at when they bought it at, and also their decision not to do repurchases right now. And I'd like to take a step back and just kind of explain our thinking on Alpha. So we think we have a business that has mine lives that stretch out 4 or 5 decades or more, 40 or 50 years or more than that. And we think that in the next 40 or 50 years, the cash flows that Alpha is likely to produce every year could range at the low end to maybe negative 50 or 100 million a year to 2-3 billion or more in a single year. It's a wide range. So the reason we made the bet is that when you have a business, currently the market cap is like 1.6 billion. When you have a business that's valued at 1.6 billion or 2 billion or even 3 billion, let's say, and over a 50-year period, on average, you'll produce, let's say, somewhere between $500 million and a couple of billion a year, maybe on average. Over that 50-year period, it could be $1 billion a year in cash flow. My response on that is, where do I sign? But that's not where the story ends. So Alpha is effectively a debt-free company, and their primary focus is to return capital to shareholders only through share repurchases. We have no issue when Alpha bought back shares at $200 a share, $300 a share, or $400 a share, or $500 a share, which they have not done because the stock hasn't gotten there yet. But I want to just kind of paint a scenario for you where let's fast forward 20 years. And let's say 20 years from now, Alpha currently has 12, 13 million shares outstanding. Let's say 20 years from now, 75 or 80% of those shares are gone. They've been bought back. So let's even say there's 3 million shares outstanding 20 years from now. There's still 30 more years of cash flows coming. And let's say 20 years from now, they're producing $1.5 billion a year in cash flow. So if you have 3 million shares, you're basically producing $500 a share in cash every year. And if a business is producing $500 a share in cash, what is that business likely to be changing hands at? Well, if it's hated and unloved, maybe $2,000 or $3,000 per share, or maybe if it's liked a lot, it could be $4,000 or $5,000 per share. If it's trading at $2,000 or $3,000 per share and they produce $500 a share in cash and they take out 20 or 25% of the stock, which already 80% is gone, we would be big proponents of that. So the Alpha bet and the coal bets in general are basically directionally those sorts of bets. So what we don't care about is we don't care about the journey to get to 80% of shares gone. So we could have 80% of shares gone by buying at $100 a share, buying at $400 a share, buying at $1,000 a share. What matters to us is that endpoint number of shares and endpoint or midpoint, not endpoint, midpoint number of shares in 20 years and midpoint cash flows at that point and that scenario. So that's how we look at Alpha. Management actually saw weakness in coal prices and they were very, very smart to basically tighten their belts, seize the buybacks, make sure that their financial condition is extremely robust, which it is. I mean, Alpha has, $450 million of cash. And even in the current depressed scenario of coal prices, which are maybe pretty much a bottom, they're losing about $30-40 million a year. So they could carry this on for quite some time before they have any issues, and they have a lot of levers to pull. I'll move on from Alpha. The question on Danaos, which is a shipping company that we have in the funds. How come Danaos was bought and sold after 1 quarter? Well, Danaos was not bought and sold after 1 quarter. I think what the person asking the question may be looking at is he may be looking at our 1231 disclosure of the entire portfolio and the 331 disclosure of our top 10 positions. So Danaos is not a top 10 position, but it's very much in the fund. We are very much long Danaos and we like the business. Moving on to offshore oil services. I do want to state that our motivations to give you some color on these bets and companies is not for these to be stock tips or someone goes and buys the stock. We don't recommend that. It's really to help you as investors have a better view of what you're invested in and why we have the bets we have. So the question on offshore oil services is, what is the rationale behind investing in offshore energy companies such as Tidewater, Valaris, and Noble at the moment? We very much like our bet in the offshore oil services space. The offshore oil services space went through a crazy orgy of overbuilding and oversupply about 12 years ago, where there was a massive surge in orders placed and ships delivered. And the industry was very oversupplied at a time when the demand was cooling off, which led to serious distress in the industry, a lot of bankruptcies. And basically, new building came to an end about 11, 12 years ago. And some of these businesses like Valaris and Noble, etc., went through restructuring. They basically had their debt wiped out, converted to equity, and they re-emerged a few years later and with very strong balance sheets and great footprint of assets. What's happened in the last 11 years is effectively the order books to build these drill ships, etc., or these offshore service vessels has slowed to a trickle to zero. And at the same time, there's been a lot of scrapping. So rates have risen quite significantly in the last 2 or 3 years. They are still not at the peak rates that we saw in 2013 or 2014, but they're very healthy rates for these companies, especially since these companies have assets without underlying debt. And if we look at some of these companies like Valaris, it's very asymmetric. Replacement cost of their assets could be 5 times or even 10 times the current market cap. And in order for a new drill ship to be built, rates would need to go up another 50 to 80% or 100% to justify the building and such. And it would take 3 to 4 years to even deliver a ship if we were to build them. Now, just to take a step back on offshore drilling, approximately 25 to 35% of the total oil produced in the world is produced offshore. And it's not very well understood, but the cost of offshore oil production is significantly lower than shale. For example, the difference between shale and offshore is that shale typically has very low capital costs to drill a few wells, whereas in offshore drilling, energy company would have to commit hundreds of millions of dollars or more. And then they would have to have a view of 20, 30 years in terms of oil prices and so on to make those bets. But once they make those bets, their all-in cost might be $30, $40 a barrel of $30, $40, $50 a barrel, which is well below where shale is at. So in the current weak oil price scenario, shale is definitely going to see a sharp drop off because there will not be new rigs and new drilling going on because the incremental cost in many wells is higher. But offshore is still profitable in most parts of the world, even at these prices. And some of that investment which went into shale may come back into offshore. So It's a very long-term bet for us where there is an asymmetric scenario here where it is entirely possible. So these companies are robust balance sheets, great cash flows. I mean, just to give you an example of Noble, for example, the dividend yield of Noble just until recently was approaching 10%, and they're not paying out everything. They're paying out about half. So Noble's effectively trading at 5 times current non-peak cash flows. And Polaris, for example, like Alpha, believes in buybacks. So their focus in terms of returning capital is more towards buyback. So we like our offshore services bet. Nothing is for sure, but we like that bet. It's not correlated with a lot of other things. Now, of course, when we had all the tariffs and everything come in, then global economy slow down. And so steel production goes down, oil demand goes down. So hopefully when we get some of these tariff things resolved, some of these things will come back, but that's a big negative in general for these bets. Our next question, there's a question on car dealerships. As part of the allocation to car dealerships, did Monish consider Carvana? Oh yeah, we've looked at Carvana a few times. I've always questioned the ethics of the promoters and board members, the father-son Garcia team. Never really had comfort with the way they go about things. And of course, the valuations and all of that. So it's always been an easy pass for us. Plus also, our car dealer bets are very heavily focused on dealerships which have new car franchises, because most of the earnings come from the back of the shop, from the parts and service, which a company like Carvana or CarMax does not have. So the used car business is okay, but I think the new car and the parts and service of the dominant brands is a excellent business. It was our view that the adoption of electric vehicles would be much slower than people thought. And if and when they did gain even mainstream acceptance, the parts and service would not really change that much. I mean, you still would have a lot of big ticket items and repairs, battery changes and all that happen with electric cars, which have to go through dealerships and all that. So we didn't see any issue on that business long term. There's a question on Occidental Petroleum. Do you think Oxy is a potential takeover candidate of Berkshire? I don't really understand why Buffett has stated they will not make an offer for control, as he really likes the business, and don't understand his reasoning, not wanting to change Oxy management. Why not? Perhaps this has to do with the Oxy preferred shares and warrants. Well, Oxy is an excellent business. Vicky Holub, who's the CEO, is world class. I mean, she's a classic Berkshire manager. I think she's truly one of the greats in the oil business. So I think Oxy is a very good business. Their footprint in the Permian is excellent. They've innovated a lot. I don't want to speculate on why Berkshire doesn't want to control the whole thing. I think sometimes Berkshire may not have an interest in owning 100% of a certain business for liability reasons and such. But I don't really have a good sense of that. I know that Buffett likes the business, and I don't think it has anything to do with him having preferred shares or warrants. There's some questions on the economy. Do the radical change in tariffs cause you to reevaluate any holdings? If so, did you come to any conclusions you'd be willing to share? Well, I think that the shock that got delivered to the global economy with all the different changes we've had and discussions we've had on tariffs is in general a net negative. I think free and fair trade is very important, and the global economy has been a big beneficiary of free trade, or mostly free trade. I do agree with President Trump that the US has not always gotten a fair deal. And also the US has given or looked the other way at many countries where their import tariffs are very high, but them exporting to the US don't face much tariffs. To some extent, some countries like India, I think, got a pass because the world thought of them as, developing or emerging economies. So they were willing to give them a pass. I think there's less willingness now to give countries a pass like that, which I think is correct. So hopefully when the dust settles, fair trade with US and many countries will become fairer. There still will probably be higher tariffs at the end of the day than what we had before. We have to see how this shakes out. But so far, it's a negative. It's a negative for pretty much almost all equities globally. So we have not really taken much of a view from a tariff perspective because, frankly, there's a lot of uncertainty. We just don't know where this thing is going to end up. And I don't like to make a lot of macro calls or think about macro things because those get pretty complicated. As a shameless cloner, have you had the time and inclination to examine the 5 Japanese trading companies that Buffett Berkshire has taken a stake in? Could the concept be cloned perhaps with smaller companies? Is this a reasonable rabbit hole to go down, or do you see better uses of your time elsewhere? I am perhaps less interested in the specifics of the answer here and more interested in to just get a sense of how you think about selecting rabbit holes. So first of all, I think that those 5 companies, I don't think it would be easy to make bets like that with smaller businesses. There's a limited number of these Japanese trading companies. So we can't really kind of go down the path and actually get companies that are similar. And my issue with those 5 businesses has been that it's outside my circle of competence. They're complicated businesses. Warren may have spent a lot more time on it and he may have gotten more comfort. He also got in at a valuation that was very compelling. So for me, it's gone into the too hard pile. And so we haven't really done anything with those companies. There's a question in general about why are you doing this? You already manage a highly successful fund. And given the ever-increasing regulatory red tape, one could argue that running such a concentrated high conviction strategy is more straightforward outside the structure of an open-ended fund like you already do with Pabrai funds. If you're like, let's say, Coke or American Express, and you are doing very well in the United States, in the early days you were only in the US, and they decide to, let's say, enter Japan, should they enter Japan or not enter Japan, and if we look at it today, we would say they should have entered every country possible. So when I look at my business interests, we've always had this issue where we are able historically to serve a very small number of families, high net worth families. I wanted to be able to serve a broader audience. And the mutual fund allows that. It does come with some work and regulations and so on, but it's been very manageable so far. And so far, I've enjoyed that journey. And I think, like I said, judging from some of the questions and such that we are getting, it's been a lot of fun so far. I'll take a look at some of the questions that have come up on the chat window to see if there's anything interesting before I go back to the list. There's a question on why do you prefer Warrior over Alpha in the met coal space? We significantly prefer Warrior. In fact, it's our favorite met coal bet. And the reason is very simple. It's an excellent low-cost operator. Every time we meet management or interact with them, or meet the miners, really impressed with the team. They're extremely good at what they do. And they've got incredible assets. So even, for example, currently, which is nuclear winter times for met coal, where Alpha is losing money, Warrior's not losing money because they're sitting so low on the cost curve. And once their Blue Creek mine comes online, they'll be even lower on the cost curve. So it's a more resilient business than Alpha is. Another question, does the AUM have to get to a certain dollar amount for the fund to stay sustainable? Yeah, we currently have, 66, 67 million in assets, which more than covers all our external costs. Mutual funds have a lot of regulatory costs. And I think that once we cross something like 150 million in assets, then we would be covering all internal and external costs. I'm really pleased with where the funds are currently in terms of size and such. So it's currently overall not profitable, but I think that all the indications point to it getting there a reasonable period of time. So we like that. There's a question on Anadolu FS and Coca-Cola ISEC. I understood that FS and I exited due to recent developments in the Russian FS business. However, I'm unclear why Coca-Cola ISEC was also exited, as it has no involvement in Russia. Again, we have not exited Coca-Cola ISEC. I think what's happening is that you're looking at all the holdings as of December 31st and only top 10 holdings on March 31st. So I think if you were able to see all of our holdings, then you would see that we have our Coca-Cola ISEC position. There's a question of if the stock market is a weighing machine in the long run, one would expect that coal stocks would be a good long run investment. However, because of ESG and other coal-hating institutions, what makes you think that the gap between price and value will close for coal stocks over time? I really hope that the gap between price and value does not close for an extremely long time. The longer that it doesn't close, the more shares we can buy back at low prices, which eventually lead to better outcome for everyone. So I really hope the ESG movement gathers a lot more steam and a lot more irrationality, and we get to buy things at ever cheaper prices. There's a question, once these businesses spin off Edelweiss, will you continue to hold the new stocks in the fund? In fact, we like those individual new spin-off companies a lot, and we would like to hold those. And I think one of the things that's going to happen, which is why spin-offs do so well, is one of the reasons why spin-offs historically have done very well is because management gets very focused on a much smaller business. They don't have to check with a parent on their decisions or what they do. And we have seen, for example, the first spin-off that Edelweiss did with Nuvama. Nuvama actually is doing far better as an independent company than it would have done if it was part of Edelweiss, because it's able to look at the landscape with a more holistic view. So yeah, we like many of the businesses. I think the alternative assets business that's going to get listed is kind of like a Brookfield or a Blackstone with higher growth in India. The CEO of that business is the founder of Edelweiss, and I've met him a few times, including once for tea at my place in Austin when he came to meet some of their potential clients in Texas, pension funds and whatnot. And yeah, that's a fantastic business, great recurring revenue. We would love to own that once that's spun out. During the recent Berkshire annual meeting, Warren mentioned they prefer not to invest in currency which depreciates over time. Just wanted to know how it or may not relate to your investment in Turkey, which is losing its currency value, because you have mentioned it doesn't matter even if it's selling at Shell's value. Well, the currency was, and Turkey's very high inflation rate and very unstable currencies were front and center when we entered the Turkish market. And we specifically looked at businesses which were effectively immune to these currency and inflation trends, or either they were immune or they were going to get tailwinds. So our airports business actually is almost completely immune, because all of their or most of their contracted revenues, even within Turkey, are in euros. So effectively, it's a Turkish business that is not dealing in lira for a lot of their revenues. They deal in lira with their costs. So actually, the high inflation has been a tailwind for them. In general, the people in Turkey get poorer because the wages don't keep up with inflation. So TAV is, for positive or negative, is a net beneficiary. And with Resas, what is a warehouse? A warehouse is land, cement, steel, concrete, paint. These are all inflation indexed automatically. In fact, in general, Resas has had significant land holdings, which have gone up very significantly in value in dollars. I mean, they've gone up exponentially in lira. But our experience in the last 6 years has been that the lira has lost 80+% of its value. And Resas's intrinsic value in US dollars has doubled or tripled in that time. So I agree with Warren that that's an accurate statement in most cases. It's just not an accurate statement across the board. Have you been able to calculate an intrinsic value for Alpha shares? It sounds like you are comfortable with them repurchasing their shares above this value, even considerably above. Well, the way I would put that question to you is, there's a business that's going to be around for 50 years, and then it goes away, and it produces cash for 50 years. And we can discount that cash to present value at some reasonable interest rate. Let's say that those cash flows, just to keep it simple, over the next 50 years are $1 billion a year for 50 years. And we have a business that's trading at $2 billion. Well, we don't need Excel, and we don't need to run a calculation, and we don't need to do an intrinsic value calculation. We know we'll make money in that scenario. If you cut that cash flow to $500 million a year, which in Alpha's case would be basically in effect making like something like $30 a ton, kind of some sort of like a 15% margin or something, not spectacular. But if a business was producing $500 million a year for 50 years and you could buy it for $2 billion, where do I sign? So We don't know what the cash flows are going to be in the next 50 years. I don't think it'll be an average aggregate of 25 billion in the next 50 years. I think it'll be higher than that. Could it be 50 billion in the next 50 years? Possible. And there are even scenarios where it could be significantly higher than that. Would not surprise me if it was even 100 billion or more. So we don't know what those cash flows are, but we're happy to sit there with the bet and let the company buy back shares when they're able to. And, we just sit there and applaud them on the sidelines. There's a question we saw in Data Roma today that you decrease the position in AMR. The 13F that gets filed has nothing to do with Pabrai Wagons fund. It has to do with the private funds that I run. And on this call, from a regulatory point of view, I cannot go into things related to the private fund. So it's not anything related to Wagons fund. So we're going to skip the question. There's a question. The fund has had a meaningful decline in value over the past 3 months. What is your assessment of the fund's future ability to compound in the future based on current holdings and valuations? So one of the good things about the Wagons fund has been that as the NAV has come down and as we've had market volatility, we've continued to see good inflows. So if we look at the total amount of money that people have sent in on a net basis to the Wagons fund from the beginning, it's around $75 or $76 million. The current value of the funds is approximately like 67 million or so, something like that. So it's kind of like a 10 to 12 or 13% decline in terms of total money that came in. A lot of that 75 million came in the last few months. So it's actually good because it came in at a time of market weakness. And that has allowed us to buy into businesses that we like at better prices. So when I look at the portfolio, it looks very undervalued. I know that there are bets in that portfolio that are not going to work out. I also know that there are bets where we will lose money. I just don't know which ones. I wish I did because I would cut those right away. But we don't need everything to work. We don't even need 50% to work. And if we are right directionally on a good portion of the portfolio, we will do very well and we can tolerate fairly high error rate. So I think it's a great position. I like the portfolio. We fully appreciate the strategic rationale behind your investments in coal and oil, as well as your positions in offshore drilling contractors. What gives you confidence that commodity prices will not remain depressed for a decade in a way that would render these businesses structurally unprofitable? If I think about Buffett's 2002 investment in PetroChina, it worked out wonderfully due to the extremely low multiple he paid and the oil price massive spike. However, the latter is not knowable. One of the things that's common about all these businesses, except Oxy, is they went through restructuring. So they went through Chapter 11, balance sheets got cleansed, and they were able to shed a lot of assets they didn't care about. And what ended up coming out the other end, what we saw is very good management teams, very good boards, and a very good asset footprint without debt. I mean, it's almost an oxymoron to have a miner without debt, but that's the way it is with Alpha and Warrior and so on. And the same with Valaris and Noble and so on. So these businesses have a somewhat unfair advantage in the sense that they're not carrying the cost of these assets as debt on their balance sheets. For the most part, they are debt-free or low debt. And that's a very important part of the equation here. And the second is that these, especially with the offshore oil companies, is they're trading at a fraction of replacement cost. Barriers to entry are extremely high. We really cannot function in a world without 25-30% of the oil production coming from offshore. Yeah, we don't know what the commodity prices are going to do, but I think that many of these companies have very low cost operations. They're very profitable. Most of them are very profitable currently, except for Alpha. And so I think it's a very asymmetric bet that we like. There's a question on Oxy. Why not make Oxy a higher conviction bet in your fund? I think demand for energy will grow a lot in the coming decades due to AI and economic development in the world. Oil and gas and coal will play an important role for years to come. Investments in this field are falling behind. Oxy has a great position to profit. Well, we like Oxy, but we like some other things better. I think they're simpler, easier to understand. smaller businesses easier to understand. Yeah, I think Oxy's thesis is quite heavily dependent on two things. One is certainly higher oil prices will help Oxy a lot. And the second is, as Charlie used to say, is they've come up with one magic trick or a couple of magic tricks with fracking. And it's possible they could come up with more magic tricks. I mean, Vicky is extremely good. She's gone hot and heavy recently into AI. They brought in some pretty smart people from Silicon Valley, data scientists and so on. So they are going into this area with an idea to, get more yield and get more efficiency. And so we'll see how that goes. Buffett has encouraged investors to consider looking at a 5-year or more time horizon when evaluating a company's earnings performance. As investors, what timeline do you, Monish, think is fair for us to use when evaluating our investment into this fund? If you have a habit of ignoring short-term volatility results, how would you set your time parameters as an investor? I think that's a great question. When the Sequoia funds, Ruin Cunniff, when they were set up 69, 70, they underperformed for 5 years straight, quite significantly. And that was a period of high volatility in 72 and 73. So I think probably a 5-year horizon is good at a minimum when you're going into equity, not just our fund, but any fund. I think you need to consider that equities can have volatility and can move around. And I personally don't really look at making investments where it'll do great in the next 3 months or the next year. I just look at, price and value and see where those bets make sense and then try to have them be somewhat non-correlated and take it from there. So that's kind of how we've positioned it. We'll take one last question. When do you envision Pabrai Wagons Fund to become available for non-US investors? Yeah, we've had a lot of interest from non-US investors. We would like the funds to get larger in the US so they have critical mass and profitability and so on. There are some changes, regulatory changes that may be coming about on ETFs. We could look at that, and ETF type structure would be available globally. That would be one easy way to address it. But we don't know at this point how this will pan out. But I thank you very much for your time. And I always enjoy the calls. I think I'm very impressed with the shareholder base, investor base we have, and the quality of the questions. So thank you very much. And thanks for being part of Wagons Fund. And we'll talk to you in a few months. See you. Bye.